Hi, my name is Nat Koch. I'm preparing this video to be added to the end of this post on the Warp Investor blog, the asymmetry danger of short selling in a high value market. So when an investor short sells, what the investor does is, let's say the investor is short selling a stock. What the investor does is to borrow the shares from someone, typically a broker, a brokerage, and then expects to return those shares later at a lower price. So the investor will then buy those shares later at a lower price and then net the difference. In doing that, the investor expects the price of those shares, the stock price, to go down. This is how a short seller makes money. Now, short selling is a risky and technical thing to do, generally speaking. Professional short sellers usually rely on the analysis of firms and the uncovering of fraud and other problems that make what they do important for society. But it's a risky business because, one, you have to borrow the shares from someone, and if the value of the shares goes up, your losses are potentially unlimited. Now, the lender of the shares, typically, if it is a brokerage, they will force you out of a short position because you have to borrow with a margin, and you should have funds in that margin. So the lender of the shares may take the funds away from you and force you out of a short position. That's one problem with short selling. When a stock is heavily shorted and the short sellers are being forced out of their positions en masse, then you have what's called a short squeeze. On the screen now you can see a graph that shows in the full blue line, the total securities sold short from the perspective of the brokerage. And in the dashed green line, you have the VIX. Typically, VIX goes up when you have a problem in the economy, and if you have the blue line going down significantly, what you have is a short squeeze because the brokerages are getting their shares back. So as you can see here, there are situations where you have the VIX going up and a lot of shares sold short being recovered by the brokerages. So that's a short squeeze. So that's what we have here in this point. Interestingly, we have a bit of a short squeeze happening at the time of this video that is being created, when you have the VIX going up and the short selling going down significantly or being squeezed. And this happened in the fourth quarter of 2025. So we had a bit of a short squeeze there. And so this is an example of a short squeeze from the perspective of the market as a whole. So in short selling, is generally risky, but short selling, the least risky way of doing short selling or motivation to do that is to sell short as a protection against downturns. So let's say you have a portfolio and you're long in the best performing firms and you're short in with the lowest performing firms. So this portfolio is kind of balanced. It's a long short portfolio, and you do that type of thing to have some protection against a downturn in your long positions, because presumably you're going to make money in the short positions. So this is what I have for today. Thank you for watching. Have a good day.